Maverick traders, welcome out to your market roundup. It's April 7th. Corey here with you. We're always going to take a look at meaningful news in the markets, which right now is all about trade. It's all about tariffs. It's all about the incoming news bombs that hit us on a day-to-day basis. We're going to talk about sector rotation. There's some bulls, there's some bears. We may be entering a consolidation phase.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the Apply button in the video description. Let's break down what happened today.
Today was kind of interesting in that we finally saw a little bit of a calm. Now, we're still trending lower, make no mistake. I'm not calling for the bottoming point, but the Dow was down 1%-ish, the S&P, NASDAQ flat, Russell still down about 1%, oil down 1.5%, gold down 1.5%, and I'm calling that a successful kind of consolidation day. The markets are priced to move, 5% in a week. So today's move to get us back to unchanged roughly across markets, with futures being down sharply on Sunday, that was a pretty decent move. But here, the daily news. This is going to be my take. Today felt like the high in the VIX, but not the low in the S&P. We'll make sense of that. And then volatility is just a fear-based indicator. But now we're going to start to see some dominoes tumble. You're going to have, this was the kickstart. You're probably going to have an economic slowdown. There's still going to be bombs of news coming out, negotiations that break down, tariffs that remain. I mean, it's going to be an interesting time period for us to deal and work our way through this. Advanced decline line, 3/4 of stocks going down today. On the 50-day moving average, a disaster with 90% of stocks in fully established downward trend. So here's the chart of the S&P. If the VIX has topped, if the VIX has probably hit its high today, why wouldn't the stock market have hit its bottom? Don't they usually move in an inverse relationship? Well, sort of. The VIX usually hits its high first. I call it the earthquake effect. The first big move, because this was set off by all these tariffs and unknowns and so on, that's the big one. And we hit a 60 on the VIX today. It will probably implode back down to a certain extent for a few days, and the stock market moves opposite, right? So this is the VIX and its first big spike here. I think we've probably peaked temporarily for the VIX. The S&P did this, and it dropped precipitously. So as the VIX goes down for a few sessions and some consolidation happens, the S&P probably bounces a little. But what happens with the VIX is that it will have ricochets, what we would consider to be aftershocks. If the first one is the earthquake, the second one is the aftershock, and the next spike up might go to 48 or something, right? So we fall down into the low 40s, then we go back to 48. Then we fall maybe into the 30s, and we go back to 39. And then we fall lower. And so the VIX kind of works its way this way. All the while, the S&P is somewhat moving inverse, but each time the VIX spikes back up, that's the S&P probably making a new low. And so stocks will often not bottom when the VIX has topped. We've seen this time and time again. This is the fear-based top. This is the capitulation of fear, and the market can't keep up this pace. Remember, this is just a gauge. All the VIX is a gauge of the amount of fear. We can't continue to fall at this rapid pace for months on end, or the market would hit zero, right? Stocks aren't going to zero. The S&P 500 is not going to zero. So we can't keep up this level of volatility, and this is just a measurement of that the overall volatility should start to get a little calmer. Now, it's still going to be wild. It's not going to be this. You're not going to see these little tiny candles. It's still going to be very, very volatile, but the bottoming point in the S&P is probably down the road. In fact, I'll say something that's probably sounds crazy. And I said this a few days ago, the S&P will probably not make new all-time highs. We were just at a new all-time high a month ago. We will probably not make new all-time highs until sometime in the 2030s, in my estimation. Now that's kind of a wild thing to say, right? Couldn't we just recover and all is forgotten? Well, first of all, to recover, you've got to make a substantial rally, right? We're down 20%, and the average bear market lasts anywhere from about 18 months to, a few years. We'll call it 2 to 3 years. So we're maybe a month or two into this thing. Usually it's 18 months to 2.5 years. Well, you've got room to go, right? This is probably not the bottoming point and all is fine and we just go to new highs. So let's fast forward a couple of years and the market's gone to new lows and all these sorts of things. We maybe went through an economic recession and such. Now we're into 2027 potentially. Then you've got to get a recovery and you've got to start working your way back to those all-time highs. And maybe that's from levels that are down in the 4,000s, maybe even high 3,000s is possible in the S&P. So it doesn't sound as crazy when you start working your way through some of the numbers, some of the statistics, some of the characteristics of this market. That's not to say we won't have some big rip your face off rallies, but I would suspect that we have seen the high in the S&P 500 for quite some time. Nasdaq, same thing. Are we going to go ripping right back up to new all-time highs in the Nasdaq? Not likely. Not likely for multiple years. I think the huge volume, I think today was a little bit of a peak in the fear and that things should start to get a little calmer. They'll still be downward trending for most stocks, but the candlesticks should tighten up. They should get smaller, not back to this, but smaller. Meaning, I think today, if you look at the size of today's candle, it's a perfect exhaustion style candle. It just, you can't keep up this pace. I mean, the S&P moving from peak to trough 10% in a day, or the Nasdaq in this case moving 10% roughly in a day. I mean, it's just wild price action. So we should start to get some inside candles. Start to mark a little bit of price here, consolidation, somewhat sideways, and then ultimately work our way lower in the future. This is the VIX. You can see we hit that 60 and then we came off of that. If you go back and look at prior VIX tops, it'll have characteristics like this: enormous size candles, but then at the peak, there will be a huge red candle like this. You get some inside days, and then it starts to kind of plummet a bit. As again, it's not a measurement of buying or selling, it's a measurement of overall volatility. Are we swinging as wildly as what we have this past week? It probably slows from that standpoint. It probably calms. And so the VIX, I think has probably hit a bit of a high. Now, for today's price action, just a mixed picture. Apple's still down sharply, but Nvidia bounced back some. We saw a little bit of green in some of the banks which had been left for dead. You can see JP Morgan, Bank of America. Some of these companies will report earnings later. Consumer mostly deep in the red. Consumer was aggressively hit today. Um, you know, only outlier was Amazon, but the rest of the consumer space, that's the deepest red area. And the expectations are that, look, things are going to hurt the consumer. Prices are going to tend to get more expensive and such. So we're probably in an environment where you've got to start taking down your projections for gross domestic product and overall growth in the US. And so this is going to take some time to play out. As we look at the weekly and monthly numbers, I mean, obviously we're in a downward trend. I would not be pushing the gas aggressively on the bearish side right here, right now. I would be playing it safe, playing it cautious. We get a little corrective phase back up. That would be a gift to a certain extent for another phase to the downside, in my estimation. Let's look at some bullish charts. Let's look at some bearish charts. maybe some trade candidates to fill slots as needed. So here's CVH. I like the fact that it rebounded to hold the 50 period moving average. Basically, the argument could be that it keeps this gap open. It gapped up to this level, often where you gap to and where you gap from are key. If it can't hold here, it's going to go down and fill that gap. But I suspect today was a kick save and a beauty. And now we can work our way back up towards the top end of the range. So CVS Healthcare, maybe a potential candidate for a bullish trade. And then also on the bullish trade side, Celsius, CELH, high base pattern, still within an upward trend, great relative strength characteristics. CELH could be a bullish candidate. That chart's probably the best of the best that you can find out there right now. On the bearish side, so many charts look like this. Huge gap, huge gap, probably a little bit of an exhaustion today. I wanted to pull these charts and saying, I think we can get a little tiny bounce, but that bounce is probably, again, a reinitiate short type of opportunity. I do not anticipate that these stocks are bottoming out big picture. Okay, another one, PSX, big drop, a little bit of stabilization. You get a little bounce here, maybe fills a gap right in there, and that would be an opportunity to probably play this as a bearish candidate. So I'm looking at markets likely stabilizing a little bit here, just a minor stabilization as overall volatility calms down. And then after that resting phase, another new low, another push to the downside seems highly likely in the weeks and months ahead. We have entered into bear market territory, and just using history as a guide, this is not COVID. COVID recovered so rapidly in a month because they sent out stimulus checks and backstop corporations and started making interest-free loans and all these sorts of things. This is not that. There is no stimulus coming. Could they cut rates? Yeah, but checks are not going out in the mail. It's just a different environment. This should be a more standard, normalized type of bear market, which means couple of years is very, very possible. CPI on Thursday, and then earnings season kicks off. We've got Delta Airlines, JP Morgan Chase, Wells Fargo, to name a few that begin to report this week. In the weeks ahead, we'll have more and more reporting. Thanks everyone for joining us. Have a great week. Stay safe out there. We'll see you next time.